Here's something most founders don't realize. When a venture capital fund raises $100 million, only 80 million actually gets invested. The rest, it's gone before a single check is even written. Since starting my career in private equity many years ago to being on the other side of the table as an operating CEO, I've seen this firsthand, how fee structures shape behavior. And I've seen founders sign term sheets without understanding what they're actually getting into. The stakes are simple. If you don't understand how your investors get paid, you can't predict how they'll behave. And that matters when they're sitting on your board making decisions about your company. Show me the incentive, I'll show you the outcome. That's what Charlie Munger always says. Today, I'm breaking down the 2 and 20 model, where it came from, how it actually works, the hidden costs nobody talks about, and why it shapes every decisions your investors make. By the end, you'll understand exactly what your investors take, when they take it, and what that means for you. Here's how we're breaking this down. 4 core sections. Checkpoint 1, the origin story, where the 2 and 20 model came from and why it stuck around for over 400 years. Checkpoint 2, the management fee, the 2% that disappears before investing starts, and why a $100 million fund might only have 75 million to deploy. Checkpoint 3, the carried interest. How the waterfall works, when investors actually get paid, and why they need you to 10x. Checkpoint 4, the alternative model. Deal by deal structures, why most funds don't use them, and what that means for alignment. By the end, you will know exactly how fund economics work, and you'll understand why investors push for outcomes that sometimes feel misaligned with founders. Let's start with where this actually came from, because the 2 and 20 model didn't emerge from some Excel spreadsheets. It's older than that. Much older. The term carry originated from the European shipping industry in the 17th century. Ship captains sailed to the Americas or Asia to collect goods and bring them home. Dangerous work, long voyages, high risk of losing everything, including your life. For this dangerous work, they were offered a carry fee equal to 20% of the goods safely returned. Think about that. You risk your life traveling to India in a wooden ship. Pirates, storms, diseases. If you make it back, you keep 1/5 of the cargo value. That's the original principal agent problem. The ship's owner can't sail it themselves. They need someone with the skill and the willingness to take the risk. But how do you align the incentives here? You give them meaningful upside if they succeed. Fast forward to modern finance, the structure originally became associated with hedge funds. Then it spread to private equity and venture capital. Same principle, different cargo. Self-inflicted pain nowadays. The 2% management fee, that came later because you need to pay salaries. You have to cover legal costs, keep the lights on. Early hedge fund managers added an annual fee calculated on assets under management. 2% became standard. 20% carried stayed from the shipping days. It's an interesting point. The model survived because it actually works. I mean, by all means, not perfectly, but it creates alignment. The GP only gets rich if the LPs get rich first. That's the theory anyway. I've seen this play out in PE. The management fee keeps the team fed, the carry makes them hungry. Without the carry, you're just an asset manager collecting a steady paycheck. With the carry, you're incentivized to take risks and push for outperformance. For entrepreneurs, founders and CEOs flirting with taking on money from PE or VC, this is important to understand. The investors are playing a game that's been running for 400 years. The structure shapes behavior. The carry makes them swing for exits. The management fee makes them raise bigger and bigger funds. Understanding this history helps you predict what they'll do next. Now let's break down how these fees actually work in practice. So that's where 2 and 20 came from, but the 2% isn't just 2%. Here's how it works. The management fee is typically 2% of the total assets under management, charged annually to pay partners, support staff, legal costs, and fund administration expenses. But let's do the maths on a $100 million fund. 2% per year is $2 million. Over a typical 10-year fund life, that's $20 million in management fees. Your $100 million fund, it now has $80 million to invest. But it gets much worse. That 80 million needs to return 100 million just to break even, not to generate a return, just to get back to zero. Before your investors see any profits, the fund needs to generate at least a 1.25x multiple. That's the starting point. And that's the base case because there are additional costs that often get buried in the limited partnership agreement. Some funds charge extra costs like fund administration, bringing the effective fee up to 2.2 or 2.3%. There are also fundraising fees, organization costs, legal structuring. By the time you account for everything, some funds end up with investable capital as low as 75% or even 70% of the total capital committed. Your $100 million fund, it might only have 75 million to deploy. I've reviewed LPA's limited partnership agreements where the fee structure was far more aggressive than the headline 2 and 20. One fund I looked at had a 2.5% management fee during the investment period, and then it dropped to 2%, during the harvest period, but it also charged deal fees, monitoring fees, and transaction fees on top. The LPs in that fund needed serious outperformance just to hit market returns after all the fees. That's why sophisticated investors dig into the LPA. The headline rate tells you almost nothing. The industry has gotten a lot of scrutiny in recent years as the returns dried up, but the partner salaries didn't. Especially funds that have gotten huge. They charge less management fees nowadays. LPs these days have options. If you're raising a $500 million fund, you might charge 1.5% instead of 2%. At that scale, 1.5% of 500 million is still 7.5 million per year. More than enough to run operations. Let's look into what this means for founders. Your investors need to return significant multiples just to cover their fees. That shapes their entire strategy. They can't invest in businesses that might return 1.5x or 2x. They need shots at 10x or more. This is why VCs pass on profitable, growing businesses. It's not because the business is bad, it's because the fund economics don't work. They need outlier returns. The fee structure demands it. Also, pay attention to fund size. A $50 million fund and a $500 million fund operate completely differently. The smaller fund can write 2 million checks and still generate meaningful returns. The larger fund needs to write $20 million checks just to move the needle. Same 2% fee, completely different behavior. One more thing, management fees decline over time in most funds. During the initial years when the team is actively sourcing deals and conducting due diligence, the full management fee applies. As the fund matures, it shifts focus to managing existing portfolio companies. The fee often decreases. This acknowledges the changing nature of the work. And managers would usually already be on the next fund, which generates the new management fee. So when someone tells you their fund charges a 2 and 20, dig deeper. Ask about the fee structure across the fund lifecycle. Ask what other costs are charged to the fund. The difference between the committed capital and the investable capital matters enormously. Now let's talk about the 20, the carry. This is where fund managers actually make their money. The management fee keeps the lights on, but the carry, that's where the real incentives live. Here's how that works. Carried interest is the portion of profits that goes to the fund managers. 20% is standard, but the structure of how and when they get paid matters just as much as the percentage. Let's look at a very basic waterfall structure. 4 tiers, each one fills before money flows to the next. That's why it's called a waterfall. Tier 1, return of the capital. 100% of distributions go to investors until they've received back their entire initial investments. Tier 2, that's a preferred return. Once investors have their capital back, they continue to receive 100% of distributions up to a certain hurdle rate, typically 8% annually. This is their minimum expected return. You can think of it as compensation for risk and illiquidity throughout the life cycle. Tier 3, the catch-up. After the preferred return is met, the GP receives 100% of the next distributions until they've caught up to their 20% share because of the 80-20 profit share. This retroactively applies the carry to all the profits, not just the profits above the hurdle rate. Tier 4, the carried interest split. Beyond the catch-up, remaining profits are split 80% to the LPs and 20% to the GP. Let me give you an actual example with numbers. Imagine you have a $100 million fund that generates 40 million in profits. Let's just run with that. Total proceeds are 140 million. First, return the capital. 100 million goes back to the LPs. Second, the preferred return. This is a little more complicated because the 8% is only applied once the capital is called. So let's assume, just to make the numbers work, the 8% is a total of 8 million. It's maybe a little low, but for the sake of this example, this flows to the LPs. Third, the GP catch-up. We already know that all of the money invested has been returned to the LPs. Beyond that, there's an 80-20 split, but the LPs just got their preferred return. So for that balance to be restored, there's a catch-up that flows to the GP entirely. The total 40 million profits will be shared 80% to the LPs, so 32 million, and 20% to the GP, so 8 million. Since the LPs just got 8 million, that's 80% of 10 million, so the next 2 million go to the GP. I hope you're following. Fourth, remaining split. After the catch-up, there's 30 million left of profits in the pot. This splits 80-20, so the LPs get 20 million and the GP gets 6 million. Total GP take means 2 million from the catch-up plus 6 million from the split. That's 8 million in total, 20% of 40 million. Now there's a nuance here that's quite important. There are two types of waterfalls, European and American. Under a European waterfall, carried interest is calculated at the fund level across all of the deals. The GP doesn't begin to take carry until the fund returned all LP contributions across all deals and delivered the preferred return. In an American waterfall, the GP can collect carry on early winners even if later deals lose money. This can result in the GP receiving carried interest on a fund that is underperforming its hurdle rate, provided that individual deals have outperformed the preferred return. European waterfalls are more LP friendly. The GP has to wait longer, but it ensures that carry only gets paid if the entire fund performs. Most funds actually use European waterfalls. There's a big push from LPs to make that happen. In the future, when you come across a fund manager, ask which structure they use. It tells you a lot about alignment. For you as a founder, this means that your investors' carry only pays out if they generate significant returns. That 8% hurdle might not sound like much, but it compounds, and it compounds over 10 years. That's very meaningful. Actually, 8% over 10 years is a multiple of over 2x. And every year that passes, the GP has to give 8% to their investors, and that delays their 80-20 split. This is why VC and PE funds are all about speed and why they chase large return. A 2x return doesn't move the needle. Remember, if there's not enough to go around, the GP doesn't get any carry. Only beyond that, the GP starts making serious money. Keep this in mind when an investor pushes you towards aggressive growth, when they push you to raise the next round quickly, when they push you towards an acquisition offer that may feel premature. They're just responding to the incentives the fund structure creates. Understanding the waterfall helps you predict behavior. It helps you choose the right capital partner. Not all money is equal. Now let's look at an alternative, the deal-by-deal model that most funds don't actually use. So we just looked at the standard 2-in-20 waterfall, but there's another model, one that is much more fee light and therefore tries to align incentives better. The deal-by-deal structure means no annual management fee, no blind pool, just direct investment in companies you actually choose. Here's how it works. Instead of raising a committed fund where investors hand over capital for you to deploy over 10 years, you raise capital deal by deal. Each investment is made through a separate special purpose vehicle or SPV created specifically for that single company. Investors know exactly what their money is being invested in. You're selling them the underlying deal rather than asking them to trust your investment skills in a blind pool. They opt in or opt out on each opportunity. This creates fundamentally different alignment. First, independence. When there's no management fee, there's no pressure to do deals just to justify the overhead. My partners and I have other income sources, for example. We're not dependent on doing deals for deals' sake. We invest when we find companies worth backing, not when the calendar says we need to deploy capital. Second is skin in the game. We invest our own capital in every deal, not the token 1 or 2% that most fund GPs contribute. Meaningful amounts, actually. When we lose, we actually lose. That changes our behavior. Traditional VC funds typically require LPs to commit capital upfront when the GP decides when and where to deploy it. With a deal-by-deal approach, investors stay in control. They see the opportunity, they review the due diligence, decide how much to allocate, and LPs have flexibility to opt in or out if they're excited, or pass if they're not excited. This matters for portfolio construction. In a traditional fund, if you commit $1 million, for example, you're buying whatever the GP chooses across 20 or 30 companies. You might love 5 of those deals and hate the rest of them. That doesn't matter. You're in on all of them. With a deal-by-deal approach, you build your own portfolio. You allocate more to companies you believe in and less to companies that you're maybe a little uncertain about. I've watched fund managers face perverse incentive. They raise a 50 million fund. They need to deploy that capital within 3 or 4 years to show activity. So they start writing checks on companies they wouldn't have backed with their own money, because the alternative is sitting on dry powder and looking inactive. Or they do the opposite. They find an amazing company, but it falls outside of their stated geography, or the stage is wrong, the sector is wrong, and they have to pass on that amazing opportunity because the LPA agreement doesn't allow it. The fund structure constrains them. Deal-by-deal investing offers much more flexibility. You're free to invest across any sector, stage, or geography. When you find the right company, you can move. No investment committee, no LP approval, just your judgment and the investors who trust that judgment on this specific deal. Here's what this means for founders. When you're raising capital, ask how your investors get paid. A fund manager with 80 million to deploy and 2 million annual expenses needs to write checks. They need portfolio companies to fill out their fund. That creates pressure, sometimes misalignment. A deal-by-deal investor only backs companies they actually believe in. There's no pressure to deploy, no management fee to justify, no LP commitments forcing activity, just plain conviction. The trade-off, of course, is less certainty for founders. In a traditional fund, if the GP says yes, then the money is there. With deal by deal, the GP still needs to raise the SPV. That adds time, it adds execution risk. But the investors who back deal by deal opportunities are actively choosing your company. They're not passive capital in a blind pool. They've seen your deck, they've heard your story, they've opted in. That creates different dynamics, better questions, more engaged investors, stronger conviction. And more engagement might mean powerful introductions, because you never know who might have access to the right people. It's not always the ones with the largest checkbook. For my investment firm that I'm building, this is the model. No annual management fees eating into returns, no blind pool asking investors to trust us for 10 plus years, just strong companies, transparent diligence, and investors who choose to back each opportunity. The alignment is better, the incentives are cleaner, and we believe it produces better outcomes for everyone involved. Now let's wrap that up. If you're raising capital, the fee structure tells you what game your investors are playing. High management fees mean they reduce their own investable capital and therefore need to chase higher returns. Waterfalls with preferred returns mean that time is money and the clock is ticking from the moment they call the capital. Understanding this helps you choose the right partner. So here's the next question. Once you understand how PE and VC investors get paid, you need to understand how they actually differ in strategy, time horizon, and deal structure, because those differences shape everything from due diligence to your exit options. I break down the 7 fundamental differences between PE and VC in this video on the screen right now. Watch this to find out.